Is MicroStrategy flashing a massive buy signal, riding a bullish recovery? Or is this, just a brief pause in a falling trend waiting to trap the everyday retail investor?
Oh, that is the million-dollar question right now.
Right. I mean, it is April 16th, 2026, and you are looking at one of the most polarizing charts in the entire financial universe. Today, the mission of this deep dive is to unpack this specific snapshot of MicroStrategy ticker symbol MSTR. We're going to decode the dizzying numbers, the technical indicators, and the fierce debates tearing Wall Street apart over this stock right now. But before we get into the numbers, make sure to like the video, subscribe to our YouTube channel, and it's compulsory that you leave your comments and feedback down below. We want to know where you stand on this stock.
Yeah, definitely let us know because it truly is the ultimate battleground stock. And to understand the war being waged over its valuation today, you really have to look at its foundation. I mean, MicroStrategy has completely evolved.
Yeah, they aren't who they used to be.
Not at all. They started out as a legacy enterprise software provider, right? And they do still run that software business, but they've essentially transformed into the world's largest Bitcoin treasury company. The market doesn't treat them like a software company anymore. They are trading as a high beta leveraged proxy for Bitcoin itself.
Okay, let's unpack this concept of a leveraged proxy, because the sheer scale of the stock's current performance is enough to give anyone whiplash.
Oh, absolutely.
When we talk about high beta, we mean this stock moves faster and swings like much harder than the broader market, and honestly, even harder than Bitcoin itself. I mean, we are looking at a latest intraday price of $143.07, which is up 4.12% on the day.
Which sounds great on its own.
Right. But context here is everything. The 52-week range stretches from a low of $104.17 to a staggering high of $457.22. I mean, that is a massive cavern of volatility that can either create generational wealth or just completely wipe out your portfolio.
Which makes this the perfect moment to explicitly remind you, our listener, that this deep dive is a natural human debate and an exploration of the sources, the data, and the analyst reports we've gathered.
Exactly.
We're breaking down the mechanics of how this stock moves, but absolutely no financial advice is being given here. You have to evaluate your own positions and do your own research.
Always. And since we are dealing with a company swinging wildly within this $350 range, we have to look under the hood at the fundamentals. And when you look at the financials, they look completely contradictory.
Oh, they're a mess to look at.
They really are. They almost don't make sense for a publicly traded company boasting a market cap of roughly $50.38 billion.
Yeah, the hard numbers for the full year 2025 and the trailing 12 months are just staggering, and they illustrate perfectly why fundamental analysts are practically pulling their hair out right now. Let's look at the revenue first. Total revenue for 2025 was $477.23 million, with Q4 bringing in a solid $123 million of that.
Which, I mean, that sounds like a relatively healthy, stable, mid-sized software business. Nearly $500 million in revenue.
Right, until you look at the next line on the income statement. Operating income for 2025 was a catastrophic negative $5.44 billion.
Wait, negative $5 billion?
Yes. In Q4 alone, it was negative $10 million. And if we go down to net income, we are looking at negative $3.85 billion for the year.
That's just insane.
Oh, it gets worse. The fourth quarter accounted for a jaw-dropping negative $12.4 billion impact there. Cash from operations sits at negative $67.24 million, and levered free cash flow is just bleeding out at negative $3.36 billion.
Okay, I have to stop us here and really dig into this, because on paper, a $50 billion market cap company surviving a $5.44 billion operating loss just defies financial gravity.
It completely breaks the traditional rules.
Right. A traditional value investor would look at those numbers and assume the company is filing for bankruptcy tomorrow morning, but the market clearly isn't pricing it for bankruptcy.
No, not at all. And what's fascinating here is understanding the actual mechanism behind those catastrophic numbers. Look, the losses you're seeing on the income statement are predominantly massive paper losses.
Ah, okay. Paper losses.
Yeah, they are tied directly to accounting rules regarding their Bitcoin holdings. When the price of Bitcoin fluctuates downward, accounting standards force MicroStrategy to take what is called an impairment charge.
So they have to mark it down.
Exactly. They have to mark down the value of their holdings, which artificially ravages their net income on paper. But they haven't actually lost that cash. It's an accounting technicality offset by aggressive capital raises. If you want the real story of the company's health, the income statement is basically useless right now. You have to look at the balance sheet.
So To put an analogy to this, it's not just a business losing money. It's like running a local coffee shop that loses millions selling lattes. But the shop actually owns the entire city block of prime real estate beneath it.
That is a brilliant way to put it.
Right. The everyday operations of selling lattes operate at a massive loss. But the public loves the real estate strategy so much that they value the coffee shop based on the land, not the coffee.
That captures the dynamic perfectly. The mechanism relies entirely on the underlying asset. And when we look at the balance sheet, the city block of real estate in your analogy, they have $61.64 billion in total assets.
Wow. Okay.
And against that mountain of assets, they only have $10.60 billion in total liabilities. Their total debt is roughly $8.24 billion. When you do the math on that, it represents a net leverage ratio of just 11%.
That's remarkably low for how they're perceived.
It is. So after everything is accounted for, they were sitting on $51.04 billion in total equity. The income statement looks like a disaster zone, but the balance sheet is an absolute fortress.
Because traditional valuation metrics like PE ratios are functionally broken by this crypto accounting, Wall Street has largely just stopped looking at the income statement altogether. The market is treating this asset purely on momentum, support levels, and, who is actually actively hitting the buy button on the floor right now.
Which brings us directly into the technical analysis. Looking at the daily time frame, the consensus indicators are currently flashing a strong buy signal.
Strong buy. Okay.
Yeah. MicroStrategy is in a bullish recovery phase. It recently rebounded off a major triple bottom support zone between 101 and 105 shelves.
Now, for the listener who might not stare at candlestick charts all day, a triple bottom is incredibly significant. It means the stock fell to that 101 range on 3 separate occasions over a period of time, and every single time, buyers aggressively stepped in and forced the price back up.
Exactly. They defended that level.
Right. It indicates that the market fundamentally rejects pricing the stock below $100. It establishes a psychological and structural floor.
And rebounding off that floor has generated real short-term strength. The stock is currently trading above its 5-day moving average of $139.60 and well above its 50-day moving average of $131.29. But we also have to look at the momentum indicators, specifically the 14-day RSI, the Relative Strength Index. It is currently sitting at 69.86.
And the RSI is a momentum oscillator. It measures the speed and change of price movements on a scale from 0 to 100. Anything approaching the 70 line is traditionally considered overbought, meaning the asset might be due for a pullback because it ran up too fast.
It is approaching that overbought threshold, yes. But, and this is a big but, in the context of a high beta asset recovering from a strong floor, a 69.86 RSI is often interpreted by traders as a signal of pure, unadulterated momentum. Buyers are firmly in control.
Makes sense.
Furthermore, the MACD, the moving average convergence divergence, is showing a bullish crossover at 2.60.
Let's translate that MACD crossover, because that's a term thrown around a lot. It basically tracks the relationship between 2 different moving averages of the stock's price. When the short-term trend line crosses above the longer-term trend line, which is happening right now, it suggests that the upward buying pressure is accelerating. It's basically a green light for technical traders.
It really is. It tells the market that the trend direction is undeniably pointing up in the near term. You have the tactical support, what analysts are calling the April floor, firmly established at $120. The immediate challenge now is the resistance zone sitting between $145 and $152.
Here's where it gets really interesting, though. We are talking about bullish momentum pushing toward $152 ceiling, but we have to factor in the short sellers. Right now, short interest is massive. It's sitting at 11.7% of the float.
Yeah, it's huge.
To put a dollar amount on that, it is $4.48 billion betting actively against the stock.
That is just a staggering amount of capital hoping MicroStrategy fails to break that resistance.
But think about the mechanics of what happens if they are wrong. If this bullish momentum continues and pushes the price above that $150 resistance level, those short sellers start bleeding money fast.
Oh, they bleed heavily.
Right. And to close their losing bets, they are contractually forced to buy the stock. That forced buying drives the price up even faster, which forces more short sellers to buy, creating an explosive feedback loop. It's a classic short squeeze setup. We are actually seeing analyst notes theorizing that a violent squeeze could propel this stock all the way toward the $250 mark.
The structural mechanics for a squeeze are absolutely on the table. But to trigger that feedback loop, you need immense initial fuel to crack the $150 ceiling. You have to follow the money and look at who is actually accumulating shares right now.
Okay, so who's buying?
Well, institutional buying remains incredibly robust. The big funds are continuing to build their positions.
But see, I'm looking at the recent SEC filings, and there is a glaring contradiction in the order flow. While the institutions are gobbling this up, the guys actually running the ship are quietly cashing out.
Yes, the insider selling.
Yeah. CEO Fong Li dumped $456,000 worth of shares late last month, and Director Jared Patton sold off about $262,000 worth of shares at an average price of $131 just a few days ago, on April 13th. Direct insider purchases have significantly dried up compared to what we saw in 2025.
That divergence is vital to pay attention to. You have robust institutional accumulation driving the price up, while the insiders are systematically taking chips off the table at the $131 level. It forces you to question the narrative, right?
It definitely does.
Do the executives see near-term structural resistance that everyday retail traders are completely ignoring? Are they locking in profits because they know fundamentally that the $145 to $152 ceiling is going to hold?
That tension between the executives selling and the institutions buying brings us to the core debate currently tearing financial analysts apart. Is MicroStrategy an undiscovered value play, a digital goldmine leveraging a brilliant strategy? Or is it a meticulously disguised value trap waiting to crush the retail investor?
The analyst models are returning completely opposite extremes, and it entirely depends on what valuation lens you apply.
Right.
If you look at relative metrics compared to legacy software peers, and keep in mind what we discussed about their negative PE ratio and operating losses, traditional models claim the stock is an absurd 89% overvalued. By conventional standards, it is wildly expensive.
But if you flip the lens and look at discounted cap flow models, DCF models, that factor in the future potential of their digital capital, the math completely reverses. Those models suggest the stock is actually 75% undervalued. I mean, trying to reconcile an 89% overvaluation with a 75% undervaluation is enough to make a retail investor's head spin.
It really is. You reconcile those extremes by understanding the mechanics of the bull case. The optimistic scenario ignores the software business entirely and rests solely on their Bitcoin treasury. MicroStrategy holds a colossal 780,897 Bitcoin.
Wow.
Yeah. That is a hoard of digital capital, unlike anything else currently existing on the public markets.
It is a mind-bending concentration of a single asset.
It is. And the bull case relies on a very specific financial mechanism they are deploying called at-the-money, or ATM offerings.
This is the critical piece of the puzzle right here. How does the ATM offering actually work?
Essentially, they issue new shares of MicroStrategy stock to raise cash from the market. Because the stock historically trades at a massive premium to the actual value of the Bitcoin it holds, they are selling highly valued equity.
Okay, so they sell shares, get cash.
Right, and they immediately take the cash raised from selling those shares and use it to buy more Bitcoin at market price. Because they sold the stock at a premium, this transaction actually increases the total amount of Bitcoin per share for the existing stockholders, even though the total number of shares increased. It is a financial flywheel.
It is a brilliant arbitrage loop, as long as the market remains willing to pay that premium for the stock. And quietly in the background, underneath all this complex crypto maneuvering, their actual software subscription revenue is maintaining steady growth, providing just enough operational legitimacy to keep the lights on.
Exactly. That is the ultimate bullish outlook. In a best-case recovery scenario where Bitcoin continues to appreciate and the ATM flywheel keeps turning without breaking, analysts have a medium to long-term target of $263.49.
On the high end.
High-end estimates reaching deep into the future project a staggering $705 a share.
So what does this all mean for the person listening to this deep dive? Because when I hear targets like $705 a share and phrases like financial flywheel, I get incredibly nervous.
You should be.
Right. I have to push back on this bullish euphoria because this is exactly how everyday investors get decimated. They hear massive short squeeze in Bitcoin proxy and get completely blinded by the hype. They buy at the top, ignoring the underlying structural risks that the big institutions are fully hedged against.
That concern leads us directly into the bear case, and the downside risks are immense. If we look at the worst-case continuation lower, the most obvious risk is the legendary volatility of Bitcoin itself. MicroStrategy is a leveraged proxy.
So if crypto tanks,
Exactly. If the crypto market enters a sudden, prolonged downturn, a crypto winter in order, MicroStrategy's share price won't just fall alongside Bitcoin. The leverage means it will plummet exponentially harder.
And then there is the very real threat of dilution. We talked about the ATM flywheel being brilliant, but it requires constantly issuing new shares.
That relentless capital raising is a double-edged sword. If the premium to net asset value collapses or if Bitcoin's price stagnates, that constant printing of new shares means your slice of the pie as a shareholder is continuously shrinking. The strategy entirely relies on Bitcoin's price appreciating fast enough to outpace the rate at which they are diluting the stock.
I also notice in the financials some serious red flags regarding their debt structure. There are major questions about their preferred shares.
Yes, specifically their stretch preferred shares, which carry an 11% yield.
Let's explain what that means for a second. A preferred share is a class of ownership that has a higher claim on assets and earnings than common stock. Offering an 11% yield means MicroStrategy is obligated to pay out a massive return to those specific investors.
And the question the bears are asking is an 11% yield sustainable long-term for a company generating massive operating losses? Retail traders often get trapped buying the hype on momentum, entirely unaware of these complex debt obligations.
They just don't see it.
No, they buy right before a major dilution event to service that debt, or right before the crypto market corrects.
It is the absolute classic retail value trap. You buy in at $145 because of the fear of missing out on the squeeze to $250. Then the company issues a new block of stock, the price of Bitcoin dips 10% over the weekend, the MAG-ED crossover fails, and suddenly you are down 30% on your position, trapped holding the bag while the insiders who sold at $131 are sitting comfortably.
The volatility is what creates the allure, but it is entirely a double-edged sword. The same mechanics that create the conditions for a multi-billion-dollar short squeeze are the exact same mechanics that create a devastating trap for the uninformed.
Well, let's pull all of this together and synthesize the outlook. In the short term, looking over the next few weeks, the consensus across our sources leans neutral to bullish. The momentum indicators suggest strength, targeting the $152 to $172 range as the RSI exits oversold territory and the triple bottom floor holds firm.
Yeah, that lines up.
And the overarching analyst consensus right now sits at a buy, with 62% rating at a strong buy and 31% maintaining a standard buy rating.
But stepping back to long-term perspective, surviving this stock requires a stomach for extreme systemic volatility. If you were going to allocate capital to an asset with a 52-week range of $104 to $457 and structural exposure to the swings of the cryptocurrency market, you absolutely cannot be faint of heart.
Which brings us back to you. You have to evaluate your own risk tolerance before touching a chart like this. Are you looking for steady, traditional fundamentals and predictable cash flow? Because if you are, a company with negative multi-billion-dollar paper losses and an 11% yield on preferred debt should absolutely terrify you. Or, are you actively looking for a high beta leveraged proxy to supercharge your portfolio's exposure to digital assets, willing to weather the dilution risks for the potential of the flywheel?
If we connect this to the bigger picture, we have to ask ourselves a fundamental question about the evolution of modern markets. We're watching a company whose valuation has completely, unapologetically decoupled from its core software operations. As traditional PE ratios fail to capture its reality, are we witnessing the birth of a brand new type of corporate financial entity? Or, when the dust finally settles, will history look back at this as just a highly leveraged crypto fund brilliantly masquerading as a publicly traded tech stock?